Welcome to today's deep dive into technical analysis and how to read candlestick charts. As you may know, I am in the middle of a thinkorswim small account challenge with the goal of growing this account to $25,000. And in my last episode, I shared with you the only setup that I plan to trade during this challenge, focusing on pullbacks on a stock on the front side of the move. However, I noticed in the comments, some of you guys felt it was a little over your head. And so I want to take a step back here and focus on making sure we lay a solid foundation in technical analysis. In today's episode, I'm going to teach you how to read candlestick charts the right way. Now, what you might know is that most traders out there lose money. And what's also true is that most traders do not read technical analysis the right way. The incredible thing about technical analysis and reading candlestick charts is that this is a universal language of the financial markets. In fact, it doesn't matter if you trade Forex, you trade cryptocurrency, you trade futures, indices, or you trade stocks like I do. Once you learn to recognize the buy and sell signals that are right there on the chart, you're going to find trading becomes a lot more straightforward. Now, I encourage you to grab a pen and a pad of paper and take some notes because I'm going to pack a ton of content into this full in-depth training. And at the end of the episode, I'm going to share some recommended reading for those of you guys that want to continue the journey. So let's go ahead and jump in first thing on the whiteboard. Now, actually, I'll put up my full screen here just for a second so you can see my P&L for today. So today is day 3 of this small account challenge, and you can see that my account is currently sitting with $518.84 of profit. That makes it another solid green day. And so right now, my accuracy during this challenge is a solid 75%. That's about as good as it gets for me. I'm usually averaging between 68 and 70% from month to month. So being at 75% is really good, and it actually exemplifies what happens when you stick with the rules. Right now, I laid out in my last episode the one specific strategy that I would be trading during this challenge. Now, some people will say, Ross, there's a lot of different setups you could take. Why are you limiting yourself to just one? And I said, and I took an example from this book that I'll share with you right now, Thinking in Bets by Annie Duke. When she learned how to play poker, she's a professional poker player who's made millions of dollars. When she was learning how to play poker, her brother taught her, and he said, these are the only hands that you should play. It's not those are the only hands that you could possibly play. It's because those are the ones that have the highest probability of winning. And during a small account challenge, this is when I have to sort of, pull out all the stops and focus on my strategy that has the highest percentage probability of success. Because when you've got a small account, you don't have the cushion to take risks and unnecessary losses. So every single trade has to count. In my case, because it's a cash account, I can only take one trade per day with my full cash balance, and then I've got to wait until tomorrow. So I can't afford to take, 10, 15 trades a day and figure, well, maybe the accuracy is a little lower, but as long as I have enough time and enough trades, I'll be able to make up for it. No, I can only take one trade a day. Every trade has to count. So the strategy that I was sharing with you in the last 2 episodes, actually, it requires a good understanding of technical analysis. And so I want to take that step back here and lay this solid foundation. Maybe I should have already, but let's go ahead and do it right now. So first, I want to break down the anatomy of an individual candlestick. Now, candlesticks have been around actually for hundreds of years. They were created in Japan, and they were used for trading rice futures. The person who created candlestick charts actually created 2 different types of charts. He created the simple candlestick chart, which we're going to see right here, and he created the Heikin-Ashi chart, which is a blended average candlestick chart. Now, both are used today, but this standard candlestick chart is the most popular. The reason it's popular is because each candlestick, just like this, communicates 4 pieces of information. So right here, we have the open, because this candle right here, the way this was created was from 4 data points. So we've got 1 point, which is the bottom of this candle, 1 point right here, which is the top of the body, 1 point right here, which is the high, and 1 point right here, which is the low. So those 4 pieces of information on a green candle are the low, the open, the close, and the high. Now, it's possible that you'll have a candlestick shape. Of course, candlesticks come in all different shapes. And it's possible that you'll have an example where a candle opens and is also the low and closes and is also the high, in which case it just looks like that, because the open and the close are the same price, and the open and the low are the same price, and the close and the high are the same price. But what often happens is we'll have a stock where it opens, the price declines a little bit, then it comes back up, it goes all the way up to a high up here, and then it closes right here. And so we connect the open and the close prices to create this candlestick body. Some people have it filled, others leave it hollow. Either way is fine. And these upper lines are called candle wicks. Some people call them shadows, but they're called it's really called a candle wick. It's the upper candle wick that connects to the high and the lower candle wick that connects to the low. Now, for a moment, I want you to contrast this against a different type of chart that a lot of people will use. And by the way, this is a reminder. I'm glad I wrote this down. Pinned to the top of the comments and linked in the description, there's a download for my Thinkorswim layout. So if you want to use the same layout that I'm using in Thinkorswim, there's a download where you can grab that. There's also a download for my micro pullback PDF and my stock selection PDF. So make sure you guys check those out, because those are both pinned to the top of the comments and linked in the description. So a traditional line chart would be created kind of like this. The last traded price is just plotted on a chart. Last price, last price, last price, last price. And so when you connect all of those individual data points, you get a line chart. And a line chart is fine and well, and it's usually what we would see on CNBC or something like that when they're pulling up the price of a stock. They're just showing you this rudimentary line chart. But it actually leaves a lot to be desired, because we can't really read the sentiment of what was happening in these individual periods. All we have is the one data point, which was the last price traded. But if we zoomed in on that and we said, well, each one of those data points represented, let's say, a minute of time. What happened during that minute of time? So let's say, for instance, that during that minute of time, the price opened, and let's just say the open price was $6. The price then declined down to, let's say, $5.75. Then it squeezes all the way back up here to a high of, well, go all the way up to the top here, to a high of $8. An incredible move. And then let's say it drops back down and it closes right here. So if that's the close, then this is the shape of our candle. Now, what would that candle communicate to you? This candle, to me, that shape, would actually communicate some weakness. The reason is because you've got that large topping tail. Now, the last price, let's just say the last price is $6.50. So on a line chart, all you have is, oh, $6.50, boop, just the dot. But what you miss out on is the context of what actually happened during that 60-second period of time. And this is very important for active traders, because this communicates sentiment. So a green candle opens at the bottom and closes at the top. And the only difference between a green candle and a red candle is that a red candle opens at the top and then closes at the bottom. So that's the open, that's the close, and then the high and the low are the same. So we need the colors of the candles to be different. And if you're colorblind, you could have one be hollow and the other is empty or solid. So that way you can see clearly that they're different. But you need to be able to distinguish candles that are going up from candles that are going down, because the open and the close are inverted. So now let me step back here, and I'm going to show you the anatomy of a couple of different unique candlestick shapes. This is the foundation. In fact, I would say this is like learning the ABCs of the financial market, because each one of these candlestick shapes that I'm going to share with you are part of candlestick patterns that you will learn as you continue taking watching these classes that I have right here and watching some of the other classes that I've taught. So if a candle in its individual shape is part of the alphabet, then the candlestick patterns that you're about to learn are the words, and in fact, the sentences. These are just sort of the individual letters. So a candle like this here is called a long body candle. A long body candle opens near the bottom of the session and closes near the top. And what does that candle communicate? strong, bullish buying sentiment. The price goes up, 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 and it closes at the very top. That's a very strong candle. This candle right here is called a spinning top. It has this small body, and it has an upper candle wick and a lower candle wick. And a spinning top with that name kind of signifies that there's a bit of indecision happening right here. A little bit of a battle going on between the buyers and the sellers. The price moved up, but then it came down. It moved down, but it came back up. And it ended up closing, in this case, slightly green. However, this candle could also have closed slightly red, and it would still be called a spinning top, and it would still communicate the same thing, which is that there's a bit of indecision. There's a little bit of a battle here. So the sellers, or well, the buyers are buying it up, the sellers are pushing it down. There's a struggle going on inside this candle. This candle right here shows even more of a struggle. The price has opened and closed at exactly the same place. And this is called a doji. D-O-J-I. A doji candle opens and closes at the same price and typically has an upper or a lower candle wick. A standard doji looks like this, where the upper and lower candle wick are about the same in size. A long-legged doji looks more like this, where you've got this really long, stretched out upper candle wick and lower candle wick. So that's a long-legged doji. And then if you have a doji where it's just the top, there's no bottom, you know what that's called? A gravestone doji. It's an ominous name, and it's an ominous candlestick formation that communicates bearish, weak sentiment. Now, this candle clearly communicates indecision. So let me present you with a scenario. Let's say, for instance, we had a stock that made a really nice move up. It's showing, what candlestick shape is that? Long body. Long body. But notice how the bodies are getting a little bit smaller. When this happens, we can infer, based on the shape of the candlestick relative to the size of the previous candlestick, that the trend is getting exhausted. What's typically going to happen here is we're going to roll over, right? The green candles are getting smaller and smaller and smaller. In fact, what might happen is they peak at the top with a doji, a candle of indecision, where there's a battle. We finally culminate with that candle right there, and a candle of indecision after a stock has just made a 5, 10, 15% squeeze up indicates that a reversal may be coming. The confirmation would be if the next candle is red. So if the next candle is red and goes lower, that confirms the reversal is in fact beginning. And then we look for multiple candles of pullback. But what's interesting here is that in the case of a standard doji, there's that indecision. What about the gravestone doji? In the gravestone doji, the candle opens, it squeezes up, and then already begins to come back down. So by the time the candle closes, gosh, the reversal has almost, in a way, already begun simply from this topping tail. So what you'll learn is that topping tails like this are bearish. They're bearish because while buyers brought the stock up, sellers pushed the price back down. So they indicate a reversal may be coming. Now, oops, sorry about that. Now, before I show you that candlestick, I'm going to show you another one here. This one looks almost the exact same. You've got that large topping tail, and then we've got our little body. But in this case, we're actually going to change it to red. So the whole candle's going to change red. So now we went from having a small little body there to actually being a small red candle. That's called a shooting star. Now, a gravestone is bad. A shooting star is even worse. Why? Because a shooting star is not just an indicator that a reversal is about to start. It's actually showing that the reversal has already begun, right? You've got the stock that's squeezed up, and now you've already got a red candle. The next candle continuing that trend down is just confirmation. But the reversal really has already begun because that candle is red. So a shooting star at the top of a trend is another weak candlestick. Now, let's look at this one here. So this candlestick, which I just started to show you, is called a dragonfly doji. Now, this is a very interesting candle. And it actually possesses a little bit of optimism depending on where this candlestick occurs. So if that candlestick occurs at the top of a move, you have the stock that's squeezing up, and then all of a sudden here you have that little doji like that dragonfly doji. The stock sold off, but buyers bought it back up. So it actually confirms that the reversal began and then reversed, and when it continues higher, often that you get a second wave even higher. So we got a momentary pullback that immediately reversed. But let me show you a different scenario. Okay, so here's a scenario where we have long body red candles. The price is declining, but those long body candles are getting a little smaller. Okay, and then what do we culminate with at the bottom? A standard doji? Probably going to see a reversal coming back up, right? It's a candle of indecision. Indecision after the price has been very decisive indicates we may be seeing a reversal. What if we saw the dragonfly doji here? If we saw the dragonfly doji here, it would just be like seeing the gravestone doji at the top of an uptrend. This tells us the reversal is already beginning. And then there's our first candle that makes a new high, and we look for a correction even further up. What if this actually took the form just a little bit differently? What if we have that bottoming tail, but it's a small little small little green body? That candle right there is called a hammer. The reason it's called a hammer is because it's said to be hammering out the base. So the bottom becomes the base, and it's hammering out the base. This indicates the reversal has already begun. So now we've got our dragonfly doji, and now we've got our hammer. So look at this. You've just learned, was this 6 different candles? We've got our hammer, we've got our dragonfly doji, we've got our shooting star, we've got our gravestone doji, we've got a standard doji, we've got a spinning top, and we've got a long body candle, which could be either red or green. These are the basic fundamental components of every candlestick pattern. Now, we'll see candlestick patterns, of course, that vary slightly. The candles will be slightly larger in size, or the highs or the lows will be just slightly different. But once you learn the profile of what's happening here, it becomes a lot easier to read price action. So in the last class where I was teaching you the only setup that I'm going to trade, I was actually taking an excerpt right here from my full-length strategies and scaling course. This is from chapter 8. What is it? Chapter 8, long setup part 1. And so what I want to do now is I want to show you how each one of these individual candlesticks that you've just learned about become the building blocks for that setup. All right, so the psychology here is we have a stock right now that is squeezing up. All right, so let's pretend it's 7 a.m. Eastern Standard Time, and we have breaking news. So news has just come out on this stock, and it doesn't matter what it is. It's great news. Now, we could just say it's a pharmaceutical, biotech stock, and maybe it's an FDA announcement. Maybe it's clinical trials that are really great. Whatever the news is, the stock immediately spikes up. So the first thing that happens is a long body candle is created. You get that initial surge. And the way this works, for those of you guys that aren't familiar, I'm a volatility trader. So I don't trade things that aren't moving. You don't make money trading things that aren't moving. You don't buy something at 5 and sell it at 5 for a profit. You need that volatility. So what I have found is that volatility is most predictable when it's right after a company puts out breaking news. So I really have become a breaking news trader, and that's why I like trading early in the day, because that's when companies usually put out news. So traders will see the news, buy their stock, and the stock goes up during the trading session. Now, you can start trading as early as 4 a.m. with some brokers, but most brokers won't let you start trading before 7 a.m. But either way, you could trade starting early, and I'll show you in this episode how you can actually use Thinkorswim and set up your orders to execute pre-market or after hours. But we'll get back to that in a moment. So right at 7 a.m., this stock has breaking news. And you might say, Ross, how do you find the news? Well, you know what's interesting is I spent a lot of time early in my career subscribing to very expensive news feeds so I could be the first one to get breaking news. But you know what? Often I didn't know what to do with the news. I would see this news headline and I would think, wow, that looks good, I guess. I would pull up the stock, but it's not moving. And I'd say, well, it looks like good news. I'd buy the stock. 5 minutes later, 10 minutes later, nothing's happening. No one else cares about it. Well, maybe I find out later that that headline is actually a rehash of a similar headline the company put out last week. Or maybe I find out that that headline it doesn't really mean that much for that company. And so I found it very difficult to try to interpret every single breaking news headline to figure out whether or not this was actually going to make the stock go up. In fact, what I found was a lot easier was just to forget about looking at all the news headlines and just look at all the stocks right now at this moment that are actually moving up. All right. And then figure out, why is the stock moving up? So it's sort of a chicken or the egg type of thing, where instead of looking for the breaking news, I'm going to look for the stock that just made this spike. Let's say this spike is up 15% in 3 minutes, or even just 1 minute. You might think that that doesn't happen, but in fact, it happens all the time. We can look at this stock today that's right here on my chart. This is a 5-minute chart of NCNA, and this is a 5-minute candle where the stock went from $5 a share up to about $6 a share. So a solid 15% move. And then it goes up to 650 to 750, goes all the way up to 8. So you end up getting about a 30% move in 15 minutes. That's what we love as active traders. And so naturally, of course, I traded this stock and I was did pretty well on it. But we'll save that for a little bit later. Okay, so the way I find the stocks are up 10% is actually on this scanner right down here. So I'll just make this a little bit bigger here for you so you can see it better. So this scanner is called a high of day momentum scanner. And this stock currently is hitting that scanner, GNLN. The reason it's hitting that scanner is because it's actually hitting a new high of day right now. So this is the type of stock that I would pull up and I'd try to figure out, okay, why is it hitting a new high of day? I see there's a headline here from 8:30 in the morning. They're launching some type of test strip. I think this is for testing drugs inside a drink. So if you were out at a bar, you could use these test strips. Anyway, so that's the headline. That's what's driving the stock higher. So now all of a sudden, I understand the fundamental catalyst that's driving the stock up. And now I can look at the technicals and decide, is there a place where I could buy this stock? Now, as it happens right now, it's about noontime. It's not the time of day that I'm typically going to be really active trading. I usually find the peak volume and volatility is on the earlier side, and it starts to slow down and then gets really slow during the lunch hour. And then it can pick up again in the afternoon, going into power hour and then into after hours. But this is sort of a lull during the day when I'm not as apt to take any trades. But nonetheless, the way I find these stocks moving up is using these scanners. So what this scanner is telling me is it's giving me the details of the stock that I need to know that are relevant for me. It's telling me, of course, the current time. It's telling me the stock symbol. So that's the symbol, the ticker symbol that I'll type in to pull up the quotes if I want to execute a trade. It's telling me the price of the stock. And one of the things that I know is that I perform much better on stocks of a certain price range. And I learned this simply through trial and error. I wouldn't have known it any other way. So if I pull up my metrics right here, you can actually see, if we go to detailed, that we'll go to detailed, and this is $13 million right here in gross profit. Now, by the way, I always keep a copy of my audit pretty close by. This is my independent accountant's report of my trading profits, and this goes over every single statement that I've had in my account beginning on January 1st, 2017. And the reason it's January 1st, 2017 is because that's when I funded a small account with $583. So if we go back here, I'll say $583, January 1st, 2017. By the end of 2017, I had grown that account to $335,000, trading the strategies I'm sharing with you right now today. The following year, I made $499,000. The next year, I made $366,000, and I kept trading in this account. I continue to trade in that account even to this date. So that's all to say that my profits are verified and audited, and you can always check those out if you come over to warriortrading.com. Down in the footer, you'll see my broker statements. So now if we scroll down here, what we can look at is price and volume. And we'll see that I make money primarily on lower price stocks. This is all my profits. And you can see it's really in the between, I guess, $2 a share and $20 a share. This is the area where I do the best. So because I know that, when I see a stock on these scanners and I see that it's in that window of the price that I do best on, I'm much more interested in, pulling up the stock and taking a quick look at it. If I see a stock on that scanner and it's $45 a share, I may not even pull up the chart. I may not even do any technical analysis because I immediately say, nah, it's too expensive. That's not going to work for me. It's not going to work for my strategy. It's It's just not worth it. So I check the price, I see the volume, and the volume is the number of shares that have been traded today, and then I see the float. Now the float represents the number of shares available to trade. So when a company does its initial public offering, they do their IPO, they do a big IPO, and they sell a whole big block of shares onto the market. Let's say they sell 5 million shares. From that day forward, there are only 5 million shares available to trade. During the IPO day, all these people buy those shares, and then from that point forward, people are buying and selling from the same pool of shares. So on a day when the stock has breaking news and it starts to squeeze up, if you wanted to buy the whole company, well, there's only 5 million shares that you'd have to buy. And so let's say, for instance, that the stock has phenomenal news, and on this day, it's got a ton of volume. Let's say it has 50 million shares of volume. On the one hand, if it has 50 million shares of volume, one person could have bought the entire float, the entire number of shares available to trade. But what typically happens is that thousands and thousands and thousands of retail traders like you and I are actively buying and selling, buying and selling, and buying and selling. And as the volume changes hands, the price continues to move higher and higher and higher, because this 50 million shares of volume represents demand, high demand as the result of breaking news, and this represents supply. And when the supply is lighter than the demand, the stock price squeezes up very quickly. So when I see a stock on my scanners that has a float of less than 10 million shares, I'm already thinking, all right, this is something that has a very limited level of supply. That means with a strong catalyst, it could make a big move. Now, all of this is broken down in more detail in the stock selection PDF that's pinned to the top of the comments and linked in the description as part of the download. There's a whole bunch of downloads that I've made available as part of this Thinkorswim Small Account Challenge. Includes my Thinkorswim layout, my micro pullback strategy PDF, and a couple other things. So you guys can check that out and you can download it. And you can actually use the stock selection criteria that I've created if you want to use it for trying to build your own scanner, or you just want to use it to better understand the right type of stocks to trade for the momentum strategy that I trade every single day. So once a stock is hitting the scanner right here, I can also check its relative volume, which measures the total volume today relative to what's normal for that stock. So if this stock normally trades on, let's say, I don't know, 50,000 shares of volume a day, and now today it's trading on 5 million shares of volume, it's got 100 to 1 higher volume ratio than normal. Its relative volume is 100 to 1. And what I have learned is that stocks that have the highest relative volume ratios are the stocks that are usually making the big moves. In fact, I actually have a scanner right here called Top Relative Volume, and this scanner is just looking at the stocks with the highest relative volume. NCNA, which is up today, this is one of the ones that I traded and did well on in my main account. This one's got super high relative volume. It's got 554 times relative volume, right? The stock's up 150%. You've got BBLG, which made a big move. DRMA made a big move. These are all stocks making really big moves. So the relative volume is an important metric. All right, so once I've found the stock squeezing up, right? I found it on my scan, I pull up the chart, and this is what I see. One big green candle just like this. So this is the first building block of our chart. And then what typically will happen is you'll have a second big green candle. So we'll do a second big green candle here where the price is continuing to go up. And then usually we get a momentary pullback that's formed by a red candle. Now this is where we start to pay attention to the language. Is this a long body red candle or is it a small body red candle? If it's a long body red candle and it goes like this, what message does that send? That tells us that people don't like the news. Clearly, there's more sellers than there are buyers because the price is dropping. But when it's a small body red candle like this, that tells us that although there are some people selling, not too many relative to the buyers, and the price is still holding up. You see another small red candle here. Again, very light selling, small body candle. And then what if right here, let's just say for instance, what if right here we saw a doji? What would we expect might happen next? We might think this could be a reversal indicator. So then what do we look for to happen next? Well, if it's a reversal indicator, then the next thing we would want to see would be this sort of imaginary green candle that makes a move higher, right? That's what we would want to see coming next. So what we would actually do is we would pay really close attention as this next candle opens, and we would be watching, is it going to go red or is it going to go green? And if it starts to go green, the second it goes green and in fact breaks the high of this candle, that's where I'm saying, all right, I'm jumping in, and boom, I'm buying in the middle of that green candle right there. So what I'm now predicting is that this was the reversal. This is the first candle to make a new high, and now the trend is making its way back up. So one of the things that I've learned over the years is that stocks, when they're moving up, they don't go up like this. That's not the way price action occurs. What happens is you get these waves. The price moves up and then it pulls back, and then it moves up and then it pulls back, and then it moves up. And so when you have these waves, you certainly could buy anywhere during the up wave, but you may end up getting at the very tippy top and oop, it comes back down. And so in fact, I found the best place to get in is at the very bottom of this wave. But boy, that's challenging, because how do you know that you're getting in at the bottom and then it's not going to just go lower and lower and lower, right? And so rather than try to buy at the very bottom and predict that the price is going to drop, what I have to do is I actually have to wait for it to start to roll back up as it starts to squeeze back up. So what's the first indicator that it might squeeze back up? Well, if we zoom in on that little spot right there, we zoom in on that, the first thing would be watching to see if we have a doji, right? We had a number of big green candles going up, and then we had a couple of candles coming back down. So if we have a doji, that could be our candle of indecision for a move back up. What else could we have there? Well, if we refer back to our alphabet of the building blocks, we could have a bottoming tail, or sorry, a hammer right here. That would be fine. We could have a dragonfly doji like that. That would be fine too. So either of those candlestick shapes could indicate that the reversal is already beginning. So now we flip back over to here, and what we have to be prepared for, and this is what gets really interesting with trading, is that we start to get really good at pattern recognition. So if I pull up the slides here from my strategies and scaling course, in this slide deck right here, we were looking at that first candle that makes a new high. So I'm going to animate this so you can watch it. So the stock is squeezing up. It's just hit our scanners. It's moving higher, but we're waiting for a pullback. All right, finally, the pullback has begun. We're dipping down. We've got a green candle, which is good. We're starting to base out, and I'm waiting for that candle to make a new high, and boom, right there, the candle makes a new high. So that's the pattern that we want to see. Now, right here, we could see green candle, green candle, green candle, 5 green candles in a row, a little pullback, and then the first candle makes a new high as it surges higher. And this is the pattern that I absolutely love. But of course, to be able to understand this pattern, you've got to be able to understand really the language of each one of these candlestick shapes and the sentiment and the message that they're sending. So when we look here, we're already predicting what's going to happen. We're thinking, all right, we have a stock that has breaking news. It's popped up. We're in on a pullback right here. And what are we looking for? Well, we're looking for this to move higher. And so at some point here, we're going to have to base out, and then we're going to have to see the candle make a new high. So basically, we have three possible options here. We could have a doji, we could have a dragonfly doji, or we could have a hammer. Or we could potentially have a fourth option, which is just a really small body candle where it's getting smaller and smaller and smaller, so the selling is getting exhausted for the next move up. Now, these are sort of our 4 scenarios for a possible reversal back up. It's also, of course, possible that the stock does not reverse back up, it just continues to sell off. And if that's the case, we don't see any of our reversal candles, and so therefore we don't take a trade. There's no setup. This setup requires a candle to confirm that the reversal has begun. So now let's say here, in this case, we get this smaller red candle right here down, and then we're going to get a little bottoming tail hammer, okay? So now the next candle is going to go green. It's going to open right here. They open right where they closed, and as soon as this candle breaks the high of that candle right there, I'm buying, all right? So I'm in right here, and that's about my entry price. So let's say in this example, my entry price is $3 a share. What's my max loss? My max loss on this pattern has to be the low of this pullback. So let's say that's $2.95. I wouldn't hold all the way down to the low back here because that wouldn't make sense. By the time the stock comes back down to here, it's clearly selling off too much. So for this to be continuing these nice waves higher, it needs to pull back and then rally back up. So what's my profit target? A retest to the high a day. So let's say that's $3.15. Let's just say, for example. So in that particular case, we're looking for the squeeze through 315, and we'd be looking at a 15-cent profit versus a 5-cent loss, risk on the trade. So we've got a profit to loss ratio of 3-to-1, which is good. That's a good profit to loss ratio. In fact, with a 3-to-1 profit loss ratio, you could be right 25% of the time, 30% of the time, and you'd actually do just fine. Now, I think it's better to be right 50% of the time or higher, but if you've got a really good profit loss ratio, you can get away with being right a lot less than that. So now let me show you this for 1 second. I think this is important for you to understand because statistics are part of success in trading. So let's say profit, loss, and then accuracy. So let's say your average winner and your average loser are both $1. You only need to be right 50% of the time to break even, right? You cover your winners, your losers, your 50% accuracy. But let's just say your losers are 2 and your winners are only 1. Uh-oh, this is not good. Your losers are twice your winners on average. You would need to be right 66% of the time in order to break even. On the flip side, if your losers are 1 and your winners are 2, you only need to be right 33% of the time to break even. And so I always encourage traders to focus on trades where you have the potential to double whatever you're risking in profit. So you have the potential for a 2-to-1 profit to loss ratio. Now, it may not always be sustainable. There are times I've found in my career where maintaining a 2-to-1 profit to loss ratio has been tough, especially when the market is a little colder or a little choppier. Now, if we back this up right here and I look at my metrics, let's just say from July through today, whatever, I'll apply this. We'll say, okay. And let's look at my average winners. So we've got about $442,000 of profit right here. Average winners, $522. Average losers, $293. So it's not quite a 2-to-1 profit loss ratio, but it's pretty good. And the accuracy here is 65%. That's not bad. And certainly the profit is not bad either. But there have been other times where I haven't been able to manage that 2-to-1 profit to loss ratio because I've been trading too aggressively. I've been buying stocks that are a little too high, and I've been letting my losses get a little too big. So it's something you really have to be aware of and you've got to be careful about. All right, so if we go back to here, what we know is that we want a 2-to-1 profit to loss ratio. If you've got 3-to-1, 4-to-1 or higher, that's even better. And one of the things that I encourage you to do, and you could even do a screen grab if you want. You could do a screen grab of this right here and then print that out. In fact, if you download my micro pullback strategy PDF, there's screenshots in there that you can print out and you can put them on your desk. So now you want to put around your desk basically the perfect charts. And the reason you want to do it is because you want to train your mind to see that pattern and to know what's coming. Because in the moment when we're trading, we only see half the pattern. We see the first green candle, maybe we see the second, we see the first red candle, and now we have to visualize what's coming next. The traders who make the most money are the ones who are able to essentially predict the future. Now, I'm only able to predict the future a few minutes into the future, but well enough that I've been able to make money. And it's through the language of technical analysis. This is the language of the financial markets. And the incredible thing is, once you learn to see and truly visualize these charts the right way, you're going to recognize buy and sell signals all over the place. And you're going to realize, wow, you know what? I've been actually buying right into sell signals. And that's why I'm losing. I'm buying right into obvious sell signals. I just couldn't see it before now. Once you learn to train your eye to see them, you can't unsee them. So we've got this example right here, which is a stock where you've got these 5 green candles in a row, you've got these 2 red candles, a little pullback, and then we look for that next leg higher. I'll show you another example here. So this is another example where the stock kind of going sideways and then it starts to pull away right here. Right there, you get that nice move up, and then you get a little pullback, and notice that candle. That candle has a little bottoming tail. That bottoming tail is bullish. The stock dipped down and it got bought right back up. So you get a little bottoming tail. We like to see a candle like that. Now this candle here has a small topping tail. So it shows as we got to the top of the trend, it was a little exhausted and it sold off. This candle right here, there's your long-legged doji. A big doji, that's a big whip. So the stock got extended, it sold off, it bounced up all over the place, opens and closes at about the same price, but it takes you on a little bit of a roller coaster. Now, I'd like to avoid taking a unnecessary trip on a roller coaster if I can help it. So what I want to do is I want to try to really buy on these waves down, these little pullbacks, right before the next wave up, and then let it pull back again for the next wave up. Now, there's a couple more elements that we haven't talked about that are part of understanding this language. As you look at this chart, you could probably see some other things going on. We've got everything in this pane right here. We've got everything in this pane right here. And we've got a couple of other technical indicators right through here. So I'm going to share with you the way I have set up my charts. And I'm a big believer in keeping your charts as simple as possible. So I'm going to share what I think are the most essential indicators that you should use. And these are the indicators that I'm using as well. So, I'm going to just write my technical indicators. All right, so we're going to start number one with moving averages. So a moving average is the average price of a stock over a set period of time. So let's say, for instance, we've got 1, 2, 3, 4, 5, 6, 7, 8, 9. Those are 9 candles. So if you took equals sum, all 9 candles, so it'd be candle C1 through C9, and then divided by 9, you would have the average price over these last candles. That would be your average price. It would probably be right down about here, right? It would sort of be somewhere in the middle, most likely, which is fine. But at any given time, this is going to tell you the average over the last 9 candles. So this average is kind of constantly moving. And what's interesting is that this average is always staying just slightly behind the price as the price is going higher. So as the price is going higher, you've got these nice green candles, the moving averages lags just slightly behind. So we've got our green candles going up right here, and this gray moving average is lagging just behind. But notice how it becomes support right around here. So a moving average becomes a level of psychological support when a price is above it and it comes down to it. It also is a level of psychological resistance when the price is below it but comes back up to it. Now, in my trading, I use a couple of different moving averages. I use the 9, and I use the exponential moving averages because they're a little faster to react than the simple. And I use the 20 EMA, and I use the 200 EMA. And I actually color these where the 200 for me is in purple, the 20 is in blue, and then my 9 EMA is actually in gray. So I don't know, this is not going to come out very well to gray, I don't think, but well, it's kind of close. Yeah, so that's great. All right, so I'll put a little more brown on there just to gray it out a little bit, smidge more. Nah, that made too brown. Well, you get the idea. Okay, boy, really can't do one or the other. It's just got to be like that. So the 9, the 20, and the 200. These are the 3 moving averages that I use, and I use them on all time frames. Now, when it comes to time frames, something that's kind of interesting is that when we've been looking at these charts, I haven't made reference to the time frame that we're talking about. So let's step back here to this side of the whiteboard. So when we pull up a chart here, and we've got a candle that has its open, its low, its high, and its close. We don't know context. What is this? This could be 1 minute. It could represent 60 seconds of time, but it could also be 1 day. It could represent a whole day of price action. So we have to kind of get oriented with what time frame we're on. Now, as an active day trader, you know what I'm going to focus on? 1 minute, 5 minute, and daily charts primarily, but I'll also have a 10-second time frame. So these are the 4 time frames that I use on my charts. And so here's something really cool. So we're going to break this into quadrants here, and we're going to go like this. So I'm going to start with a green candle down here, and I'm going to say this is the daily. So on the daily, we have a big green candle. The stock's up 50%. So all we have basically is an open, and it's squeezed straight up, and we've got a huge green candle. Okay, So if you pulled up the daily chart, you would see that the stock is up a lot, but that wouldn't really tell you where to buy or where to sell. It's just, okay, the stock's up a lot. So then we zoom into the daily and we look at the 5-minute. So now this is going to be our 5-minute chart. And on this, what we're probably going to see is the stock had this nice rally up. And then it pulled back a little bit. And then it had another nice rally up. And then maybe it pulled back a little bit more. And maybe we're in this area here, and then we just had this candle right there. On the 1-minute, what we get to do is we get to zoom in even closer. So this last candle, that's a big green candle on the 5-minute, well, inside it has 5 1-minute candles. What do they look like? The first one, let's say it was green, but maybe the second one was red. Maybe the third one was red. And then maybe the fourth one was another big green candle, and the fifth one was a green candle. And all of that occurred inside that candle. And all of this occurred inside this daily candle. So this is the 1-minute. And now this is the 10-second chart down here. And inside this 1-minute pattern, well, you've got, let's see, 6 times 5. So you've got what, 30 10-second candles. So inside the 10-second candles, you might have seen that the stock squeezed up. And well, I guess you had a couple nice big green candles there. So it squeezed up a bit, and then it was pulling back a smidge, but maybe inside there was a teeny little green candle. Then it pulls back a little bit more, and then it kind of pushes up, but then maybe it dipped down here for a second, and then it pushes a little bit higher. And so something that's kind of incredible is how these are sort of fractals. Everything you see and everything that you're learning, you can apply to any one of these time frames. You could choose to trade exclusively on the 10-second, exclusively on the 1-minute, exclusively on the 5-minute, or exclusively on the daily. Although what a lot of active day traders will do is we'll use a combination of these time frames. And so for me, I'm really focused on this area. I check the daily chart, but once I see it's a big green candle, there's not a lot more to look at other than checking to see, is there nearby resistance? And there could be nearby resistance if, let's just say, we zoomed into this daily chart and we saw, well, this is a stock that'd been selling off for a while, but then it kind of popped up here, had a lot of resistance, then it sold off really hard, and now it's coming back up right here, and we're going to look at this and say, I don't know, might kind of have resistance right around there, right? This might be a technical level of resistance that we have an issue with. So aside from checking for resistance levels, which we would do through horizontal, but also descending and potentially ascending levels, and also looking at the 200 moving average on those daily charts, we would say, once we've done that due diligence, we would put that aside, and then we'd be focusing on our 5-minute, 1-minute, and 10-second. One of the things I can tell you is that if you have a phenomenal 10-second chart, but the 5-minute's garbage, the chart probably won't work. If you have a phenomenal 5-minute chart and the 10 seconds garbage, the stock will probably work anyways. So the bigger time frames carry more weight than the smaller time frames. So most important, second most, sort of decreasing. Not to say that a 10-second chart's not valuable, but these candles are so short that any degree of strong sentiment that they're communicating is obviously short-lived because it's a 10-second time frame. Nonetheless, I do find it helpful. Okay, so on all time frames, I use these indicators, the 9, the 20, and the 200. Now, the second indicator that I use is called VWAP, the volume weighted average price. The volume weighted average price is actually a lot like a moving average. It averages the price, so it's equal sum, C1 through C current, all of those. And then it's also adding up all of the volume, so volume from V1 through V current, and then it gives you the average price of the stock factoring in the volume that took place as it was trading. And these aren't indicators that I just came up with. These are indicators that have been used and are well respected. They've been used for decades, and they're well respected by traders all across the financial markets. And it's, again, not just the stock market. Traders are using this in cryptocurrency and Forex and indices and large caps and everything. So the volume weighted average price, I have it as a orange line here on my charts. And that is the equilibrium price. That really is like the average price of the stock over the course of the day. So I really like the volume weighted average price. What I find is that when the stock is above VWAP, it's bullish. When it's below VWAP, it's bearish. So if we go back here and actually, you know what? I'll just, rather than do that, I'll just show you from an actual chart on a stock today. So let's look at this one, for instance. So this is an interesting one because this has really had a bit of a battle at the volume weighted average price. So the volume weighted average price is that orange line, and you could see we were above it and then below it, and then broke above it, and then came back down. We were below it, and then we were above it, and then below it, and it was really a battle. This one's really been struggling. GNLN, what about this one? No, this one's just been solidly above it. What about BBLG? BBLG, this one, kind of trading, right around it as well. It comes down to it, and then it gets right back above it. Comes down to it, well, we'll have to see what happens. So the volume weighted average price, it's the equilibrium price for the stock. So that's the place that's sort of like slack tide. Neither the bears nor the bulls are in charge. But when we're above, the bulls are in charge, and when we're below, the bears are in charge. So it's important to know your place in the market. And if you're trying to trade to the long side and you're trading a stock that's below the VWAP, you're trading against the trend. It's always going to be harder when you're fighting against the trend. So number 2 is volume weighted average price. It's an intraday indicator. It actually doesn't work on your daily charts. Number 3, we have volume bars. So volume bars are a visual representation of the actual volume that takes place during each individual candlestick period. And this is extremely interesting because what the volume will tell us very clearly is how many buyers or sellers we have during this period of time. So right here, when we see these big green bars, they're right underneath these green candlesticks. So they're telling us how much buying volume we have on that candlestick. And this is especially telling when it's a nice profile like this, where you've got that increasing volume and then light volume selling. Now imagine something like this, where you have light volume buying and high volume selling. Now that tells a very different story, right? That tells us the price is going up on basically no volume, but sellers are dominating. In total, who's in control, the buyers or the sellers? It's the sellers. And you would know that even if you didn't even look at the candlestick shape, you only looked at this right here, you could draw that same conclusion that the sellers are in control. And so this is a vital piece of information to be including. If you colored your volume bars to always be like, let's say blue, they wouldn't tell you the buy and the sell, and that you wouldn't be able to interpret the correct sentiment. So you've got to make sure that they're colored based on the color of the candle, so you understand, is there more buying or is there more selling? There's this one. Yep, these are both examples where there's a lot more selling. So that's something that's really important to pay attention to. So this platform that I'm using right here is called Day Trade Dash. I've been developing this platform for the last 7 years with my own development team, and I built it out to be the ultimate dashboard for active trading, and I really wanted it to be something that every active trader would use. I use it every single day in my own trading. Of course, our members at Warrior Trading, most of them do as well. But you can color these as you'd like, but it was very important to me that you were able to clearly see volume. You have to be able to see the volume, because the volume is going to tell you the story. Now, it gives you the context behind these individual candlestick shapes. All right, so now we've got volume, and the next indicator that we're going to cover, number 4, is MACD. Now, this is a really interesting one. The MACD this is an acronym that stands for Moving Average Convergence Divergence Indicator. Okay, so what does that mean? Well, when a stock is moving higher, and I'll just do individual lines here just to make it simple. When a stock is moving higher, well, first of all, the stock is moving higher like this, and then we've got our volume bars down here. So we'll have volume right here. So we'll have volume right here. So we want to see that the volume is moving higher as well as the stock is moving higher. We get a little bit of a pullback here, and we want to see light volume pullback. And then the price surges back up like this. We want to see buying volume goes back up too, right? That's what we want to see. And then a little pullback here. But what happens, let's say, if we see something like this? What is that going to do to the moving averages? Well, for the 9 moving average, which was coming nice and gradually, it's going to drop it down like that, right? Or for the 20. For the 9, which was even closer, it's going to do the same. In fact, they might even cross over. The 9 and the 20 might cross. And if they cross, what's going to happen is your moving average convergence divergence indicator is going to send a signal. So the MACD is right down here. And what the MACD does is it's oscillating like this, and then it'll come back up and it goes back down. And when the moving averages are pulling away, the stock is moving higher because the average price over the last 9 candles, let's just think about how this works. Over the last 9 candles, as this price has been squeezing up, the average price is going to be higher than the average of the last the last 20 candles. If you include another 10 candles back here, 11 candles, the average is going to be lower because the price goes back further. So the 9 is always going to be higher than the 20, except when you get a quick reversal. When you get a quick correction, well, the 9 could actually dip below the 20 because the longer period moving average is actually sustaining those higher prices because it's including some of these higher price candles, whereas the 9 is now weighting this big red candle more heavily. So what ends up happening is you get this reversal. And so I like to trade when the MACD, the orange line, is above the signal line. And once they cross over like this, usually I don't want to take a trade. So this is a very important indicator. And this crossover is something I pay a lot of attention to. I want to be trading when the MACD is above the signal line because that tells me that right here, we're on the front side of the move. So if you watched either of the other classes that are part of this series, which is the Thinkorswim Small Account Challenge, you'll know that I had mentioned I'm going to be focusing on one setup. My absolute favorite setup that I think has the highest probability of success. And that setup is trading stocks on the front side of the move when they're squeezing up and not overstaying my welcome by trading the backside. So we pull up Thinkorswim here and you can see I'm up, there it is. I'm up $518 today trading OBLG. So this morning, we had several stocks that started popping up. NCNA was the first one that popped up. NCNA comes up, and this one right here, I said, it is going straight up, which I like. And I actually tried to take a trade on it, but I did not get filled. So I wasn't able to chase it. And the trade that I tried to take on it, we'll go into the 10-second chart, was right around 650. So what I was looking for was, okay, first pullback following the fresh breakout right here. We get the squeeze up, we get that little dip. That's the first pullback. Tried to get in, and it ends up going higher without me. My order got rejected. It did not get filled. And the reason it didn't get filled was because I had made a mistake right here in Thinkorswim. The mistake I made was that when you're trading pre-market with Thinkorswim, you of course have to change your order to an extended hours order. And I clicked right here. I just clicked the buy button, and that's a stop order. I have to press Control to change it to a limit order. As simple as that, but that was my mistake. I didn't press Control to change it to a limit order. I pressed Stop. Stop orders don't work pre-market. So my order got rejected. And when it squeezed up, I said, well, I don't want to chase it. I can't afford, I can't chase it. If I miss my entry, I miss my entry, and it's better just to wait for the next one. So this ends up squeezing up, and I traded it in my main account, and that was just fine. Now in this little stretch right here, the MACD was, of course, open. The MACD is above the signal line, and you're seeing that nice squeeze. Now, actually, I inverted it in my drawing. The blue is above the signal line. You could change your colors if you want, but when the price is moving higher, you'll see that it's open like this, and then that first crossover is when things get choppy. And although sometimes it'll move higher in spite of being crossed over, the easiest trades for me are always on the front side. And so for the small account challenge, that's where I want to be trading. So then the next stock that popped up was BBLG. So BBLG pops up, it hits my scanner, I pull it up, and I'm like, all right, BBLG, I like the look of this one. Let's look for that first pullback. So as BBLG starts popping up, I'm thinking, where's the pullback? Where's the pullback? And unfortunately, what ends up happening on this one is it squeezes pretty much all the way to about $1.70. It pulls back only for a moment, and then it pushes higher. And I couldn't find any news. I couldn't find any news to substantiate the move. And so I thought if there's no clear news headline, this will probably reverse. I don't think I can trust it. So I didn't take the trade on it. I said, nope, I can't take the trade. So that one's no good. And then we had another one. We had, let's see, was it NVAX? No, it was, what was it? VRAX. Sorry, VRAX. VRAX then pops up. Or maybe, I can't remember the order, but anyways, VRAX pops up. And when VRAX pops up right here, I tried to get in right here for the entry at 315 because I thought it popped up, sideways consolidation, and I was too slow. It goes without me. It happens so fast. Next thing you know, it's at 320, 330, 350. Son of a gun, it goes up to 4. Oh, I missed it. All right. So I missed that one. So then when OBLG hits my scanners, and I'm like, all right, I'm not going to miss this one. No way, Jose. So OBLG hits my scanner right here. I'm going to show you where it hit my scanner. I'll actually just change this to a 10-second chart. This hits my scanner, and I said, I like the price, and I like the float. The price on this is $5, and the float on this is 698,000 shares. So as it pops up right here, I've got to go back here. So right here, it pops up. And I actually pressed the buy button right here. Right there, we had a micro pullback. It hits a high of 6. It dipped down for a second. Do you see how you have that topping tail right there? Now you got to get zoomed in. See how you have that topping tail? So there's a little top. What that tells me is that the price actually tapped $6. It pulled back just for a moment. As it came back up, I got in at 6. I bought right at $6, and the next candle, let's watch, it pops up to 624, excellent, and it ends up hitting a high right here of 637. Now, what did I say during my episode just the other day? I said my focus is to trade the front side of this move right here. So I made a couple of rules. I said, number 1, front side. Number 2, MACD, positive. Number 3, price has to be most likely under 10. I can't trade higher price stocks because the account's too small. Number 4, goal is 10 to 20 cents. And number 5, don't go back. Which is to say, one trade, get in, get green, don't go back. Get your 10, 20 cents. So I got in at 6. It immediately breaks 6. It goes up to 630, 640. I took my profit off the table. And I'm thinking, all right, good job. You locked up some profit. Now I'm thinking, all right, I've got my first little profit on this in my main account, in my small account. Let's see if there's going to be another trade on this. And what ended up happening on this one is, and I'm really glad I took some profit, the next candle, it stalls out right here and it double tops. What are these candles telling us? A double top. We tap this, the sellers push it back down. We come up again, the sellers push it back down. So now I'm thinking, oh, we've got resistance up here. These topping tails are signifying weakness against this level. All right, that's a problem. And so it ended up pulling back down. It goes sideways for a second, it comes back up, but it just sort of levels out and it doesn't end up holding. And I was like, you know what? That one trade, that quick little entry right at the $0.50 whole dollar was good, but I was kind of disappointed. And the reason I was disappointed was because we had some of these other stocks that made some really nice moves. Well, GNLN, this one popped up. That one's doing doing nicely right now. But BBLG, VRAX, we had NCNA, and several of them I tried to get in, I didn't get filled. And finally I get filled on one and it goes up 40 cents and then it rolls over. So one of the things I think is really key about the strategy that I'm trading is that I focus on taking my gains. I take my profit and then I go on to the next trade. So now with $518.84, this account now has $14,472.35. The goal is $25,000. So I've got about $10,500 to go before I hit that goal. Now, it might take me, well, at the rate of $500 a day, it's going to take me 22 days to get there. And look, there's going to be some red days. So it's going to take some time. But my goal is to try to keep locking up $500 a day as frequently as I can. I'm figuring $1,000 a week. And the reason I figure that is because I don't think I'll find a great setup every single day. And I'll probably have a red day maybe once a week. I hope I can avoid it, but it's not impossible. So by focusing on high quality setups, the quantity of trades will go down, but the accuracy will go up. And you know what that creates? A positive feedback loop. So we're talking about positive feedback loops in trading. This is something you've got to be thinking about. Focus first on A quality setups. That will improve your profit to loss ratio, which then improves your consistency. So your calendar is going to have more green days, which then improves your self-confidence. So we'll do iron bells, like lifting weights. Makes you feel stronger. And then you're going to take bigger share size. And then your profits are going to be bigger. And then you feel more confident and you have this positive feedback loop. But you know what? If you're not careful, you could find yourself on a negative feedback loop. And that's what I've seen for so many traders. They get themselves on negative feedback loop where they trade with low accuracy. They have low profit loss ratio. They have poor consistency. They have poor self-confidence, and they start getting desperate. They start getting frustrated, and they start spiraling. I want you to avoid that at all costs. So what I want to encourage you to do is make sure you download the free downloads, the free PDFs that are available as part of this Thinkorswim challenge. They are linked to the top of the comments and in the description. And I want to make sure you subscribe to this channel to watch more episodes about trading strategy just like this. You are scratching the top of the surface. If you want to keep learning, make sure you check out this book right here, Thinking in Bets by Annie Duke. I've got another one here by Annie Duke called Quit. That's a great book. Of course, I've got my book right here, How to Day Trade, The Plain Truth. We've got The Happiness Advantage by Sean Acor, which I think is terrific. And we've got Trade Mindfully by Gary Dayton. Thank you guys for tuning in this episode. I'm looking forward to seeing you for the next one real soon. I'll remind you as always that trading is risky. My results aren't typical, so manage your risk, take it slow. I'll see you back here for my next upload.